Alright, before you buy another dividend stock, watch this video. You can get 5% returns on CDs from your banks and even in your investing account right now. And I'm going to show you how to get these CDs, how they work, and what you can expect in the future. So to give you an idea of what's going on, inside of your investing account right now, there's usually a section for bonds and CDs. And here you can see it's listed all out, everything from municipal bonds to treasury bonds to CDs. And you see here, moving forward one screen, you see here we have rates from 4.96% for a 1-year CD all the way up to over 5% for a 1 to 3 year CD, meaning that if you put money into the CD, you get 5% back each year over 1 to 3 years. So for example, if you were to put $10,000 into one of these CDs locked up for 1 to 3 years, 5% back is $500 every year, and sometimes this interest is compounding. Now let's talk about the advantages of a CD that you buy from your bank. And by the way, CD stands for Certificate of Deposit. Let's talk about how these rank up against dividend stocks. So dividend stock, there are some advantages. You can sell your dividend stock at any time. If you don't like the stock, if you don't like the price, whatever, you can sell and get out of it. Whereas with a CD that you're buying from your bank, you can't sell that CD often without paying a penalty or losing out on your interest payments. But at the same time too, dividend stocks are volatile. A dividend stock can go up, and sometimes a dividend stock can go down. Whereas a CD from a bank, you know exactly what you're getting up front. The price of it does not change. And then finally, too, there are guaranteed FDIC returns, meaning that a CD is as close to 100% safe out of everything because it's FDIC insured. It's as safe as your bank account. You lock up your money and make a deal with your bank. Usually it's ranging from 1 year to about 10 years. You say, here's my $1,000 bank, you can keep it for a year, but I want something in return. And what you usually get in return are high interest payments. Now for some people, sometimes you actually can withdraw the interest from your CD without touching the principal, meaning that you can give the bank $10,000, they pay you $500 in interest over the year. You can withdraw that $500 as long as you don't touch the original amount you gave to the bank. So in some scenarios, it can work to get you passive income. And this is one really cool thing too. Similar to dividend stocks that you can reinvest, you can compound your interest in your CD while you're waiting for the CD to expire. So let's say you have a CD, it pays you once per year. This doesn't usually happen. Sometimes they pay you monthly, but let's say you have a CD, it only pays you one time per year. You have $10,000, it pays you $500. Now you have $10,500 in your CD. Then in the following year, you're getting 5% on $10,500, meaning that in the next year, they'll pay you $525 versus $500 the year before, meaning that your interest rate payments just gave you a $25 raise. And the great thing too is you don't actually have to go into your bank account. I found this out relatively recently, but you can actually buy CDs inside of your stock trading account right now. You can't buy them, I think, on something like Robinhood, but for example, on brokerages like Vanguard, Merrill Lynch, TD Ameritrade, Charles Schwab, and Fidelity, you can buy CDs for even higher interest rates than what you typically see on a bank account's website. Here we are on Capital One. You can see there they are advertising CDs for you to buy right now. But looking at this right now, you see the 1-year CDs only pay 4.15%. The 2 years pay 4.3%. In our investing account, we can get higher percentage rates, 4.96% or 5.02%. And also, unlike your bank account, when you buy a CD from your investing account, unlike your bank account, they offer many different types of CDs you can get simultaneously from banks all across the country, whereas your bank may only offer you 3 to 4 different kinds of CDs. So now I'm going to show you a live demo, step by step, click by click, how to get a CD right now for up to a 5% interest rate. So here we are on my investing account. You can see here I use TD Ameritrade, and it's going to be very similar to your brokerage account as well. So all you would do is go to something like your trade tab, see that populate down, and under stocks, options, there's also something called bonds and CDs. So let's click that. And then immediately you're brought to the screen I showed you before in the presentation. You have CDs. You can choose between how long you want to lock up your money. Let's say you want to lock up your money for 5 years, you can do that. Or just 1 year, you can choose here. And by the way, too, they also sell treasuries here as well, but in this video, we're going to focus only on CDs. So let's decide, okay, we want to get a CD. You click that, and then you're brought to this page that explains all the information for the CDs. So we're going to sort through CDs to see which ones are the best ones, and don't worry, I'm going to show you exactly what every single one of these things means. So you can see in the middle of the page here, there are two things we're going to look at. There are non-callable CDs versus callable CDs. Non-callable CDs means that the bank can't pay to redeem your CD early. So let's say the bank offers you a $1,000 CD, it's paying a 5% interest rate. Your bank doesn't like that your CD is paying you so much in interest. They're going to pay to cancel that CD early, so that way you're not getting extra interest payments. Often people want to lock in a very long interest rate. They don't want the bank to suddenly pay back and then you lose your CD and then you have to find another one. What you can do is you can sort by non-callable CDs And that means the bank is obligated. They have to honor your CD for that 1 year period, that 5 year period. They can't cancel it or pay you back for your CD early. Many investors choose non-callable CDs because they want that guaranteed return and that guaranteed interest without having to worry about the bank changing the deal. Now we're going to want a 1 to year CD, so we're going to click that. So as we keep going, let's sort this list by APY. And APY stands for average percentage yield. That means that's the annual rate, the annual percentage you're going to get on one of these CDs from one of these banks. So that way we're ranking it from top to bottom. So we see here we're starting at 5.1 and we go all the way down here into the 4s. And then on the left, you see coupon maturity. So this is when your CD finishes and you can get your principal and all of your money back. So you see here, this one finishes on the 26th of April, 2024. That's almost exactly 1 year from now. And we see here it pays 5.1% annually. Then also one over, you can see quantity versus minimum. So in this case, for many of these CDs, your minimum is only 1 CD. You can buy up to 2,000 CDs, but the lowest you have to buy is 1. Now, one thing to keep in mind is, unlike your bank account, like I said before, at least on my brokerage, the minimum is $1,000, whereas on some banks, the minimum is only $50. So let's go down and find a bank we trust. So if we scroll down here, I see there's one for Goldman Sachs. It redeems in a year. But it's callable, meaning that they can call the CD early, which is not something we necessarily want, but it does pay a 5% rate. So let's go down one more, and here we have Charles Schwab. Now this one redeems in May of next year, so it's a little bit over 1 year, it's 13 months, but it's non-callable, meaning that they have to pay your interest rate. You see here that there's a 5%, it's over a 5% rate, so we have this CD for 13 months, it pays us 5% that entire time, and we can lock in our money. So let's say we choose between Schwab or Wells Fargo. Let's go with Wells Fargo here, it's a little bit of a lower rate. It pays you 4.95%. We'll ignore Schwab there for a second. So let's hit buy. Now this takes us to the explainer page here. So this is a new bond. We're buying it on the 24th. It's FDIC insured. They can't call it. We do pay tax on it. And then the CD will mature next year in 2024. And that's when we get our original money back. Here we see too that the first coupon is next year. So this CD only pays your interest one time. You see it's paid at maturity. So this is not an example of a monthly payment. So you have to wait all the way to the end to get your money back. But then you see here the principal is $1,000, meaning that you have to buy at a minimum of $1,000. So you can choose your quantity here if you want, for example, 1 CD, and then you hit buy. And then at that point, you now have your CD. But let's try to find one, for example, that actually doesn't pay us at maturity, but pays us, for example, maybe semi-annually or monthly. So let's go back. So let's do maturity. We want at a minimum for it to expire in 2024, so it's 1 year. We want a minimum quantity of 1. We want a minimum coupon price of 4.9%. We can choose all states. And let's see if we can get quarterly CD payments. And we want non-callable CDs, so we're going to hit exclude on that, and let's hit search. We see here there are 4 examples of CDs we can get. So we have here from Wells Fargo. It matures next year. It pays us 4.9%, and it's non-callable. So let's hit buy. And guess what? This CD now pays us monthly. So if you want monthly interest, you can get that as well from your own brokerage. Once again, the minimum to buy is $1,000. All right, so now let's talk about some disadvantages of CDs, now that we know how to buy them. So remember, when you buy in your brokerage, once again, there's a $1,000 minimum versus $50 at some banks. If you sell your CD on your stock account before maturity, you still may not get the full price of the CD, among other disadvantages. Another disadvantage too is that the inflation rate you can see here in the United States, even as of March 2023, is still 5%, meaning that if you get a 5% CD, if the inflation rate is 5%, you actually are making net 0% on your CD. But there is good news. You can see here that the inflation rate has been dropping since July of last year, going from 9% down to 5%, meaning that if the inflation rate were to continue dropping, you might start to make money on your CDs while it's guaranteed and safe ahead of inflation. Let's see how that works. So let's say you're getting 5% interest on your CD. There's 2% inflation because it's dropped from 5% to 2%. Now you're getting a guaranteed, safe, FDIC insured 3% return, which is better than many dividend stocks. With CDs, timing is important. Because CDs are really sensitive to interest rate changes, you can see here the interest rates in the United States have risen from 0% to 5% here in about a year. There's a lot that could happen. So for example, if you thought the interest rate was going to go down from here, it might make sense to lock up your money for one of these long CDs, let's say 3 to 5 years. That way you're getting consistently 5% paid to you even after interest rates have gone down, making your CD more valuable. But if you know that interest rates are going to go up more from here, it might make sense to only get a shorter term, let's say a 1-year CD, so that way your money is returned back and you can get a new CD after that for a higher rate. Or if the interest rates stay the same, you have nothing to worry about. So once again, it really depends. If interest rates you know are going to go down, it might make sense to get longer term CDs. If you know interest rates are going to go up, then it might make sense to get shorter term CDs. Now that's all for this video. If you're still not totally sold on CDs, that's perfectly fine. Instead, check out this video I made about qualified dividend stocks that actually cost you less in taxes compared to other dividend companies. You don't want to miss this video.